Hello there, and welcome back to the Groundfloor Market Trends podcast. I'm Patrick Donahue, Vice President of Market Risk at Groundfloor, and you're tuning into episode 4. Today, we've got some exciting updates to share. We're going to be talking about the Fed's upcoming meeting and the potential for rate cuts in that meeting, and what's going on with housing inventory and the latest on builder sentiment, and how Groundfloor's stock offering presents a unique opportunity for investors like you. But before we dive in, make sure to check out our Market Trends blog for even more insights. You can find the latest blog on our website, groundfloor.com. Just go to the section where it says Learn and then Blog. It's packed with deeper analysis on these topics and much more, so don't miss out. Okay, we got a lot to cover today, so let's get into it. First, I did want to share some exciting news about the Groundfloor stock offering. So if you've been with us for a while, you know Groundfloor has always been about making real estate investing accessible to everyone, whether you're starting with as little as $10 or building a more robust portfolio. But now you can take that involvement to the next level. You can be an owner of the company. You can own a part of Groundfloor itself. That's right. You now have the chance to invest directly into Groundfloor and help shape our future growth. We already have commitments for over $645,000 with more than 270 investors on board, and there's still time to get involved with a minimum investment of just $100. Groundfloor has been growing rapidly. We're managing over $300 million in assets and counting, with 270,000 registered users. What's more, we've been recognized at places like Forbes FinTech 50 list for 2024. It is the largest platform for fractional investments in single-family real estate. We're opening doors for everyday investors like you to get in on private real estate investing with the SEC qualified products. And with 68% compound revenue growth from 2020 to 2023, we're proud of our track record in the delivering of those results. So if you're ready to be a part of this exciting journey and learn more, head over to republic.com/groundfloor. That's republic.com/groundfloor and explore the details. Plus, if you sign up with promo code REPUBLIC, you can earn a $100 bonus when you invest $100. It's an opportunity that you do not want to miss. All right, so let's get into housing inventory. Let's take a deeper dive into the housing inventory. According to the Housing Wire economist Logan Montashami, we might have hit the peak in housing inventory for 2024, but there's a lot to this story. So in the September 1st report, he explains that higher mortgage rates over 7% have provided what he calls an inventory buffer, giving the market more available homes than we've seen in previous years. In August 23rd to August 30th, that week, inventory fell slightly from 704,744 to 704,335. That's a small dip, but it's still a very far cry from historical lows of 2022, when inventory dropped to as low as 240,497. So just to recap, August 23 to August 30th, just recently here in 2024, inventory fell slightly from 700,004 to 704,335. So it went from 704,744 to 704,335. And back in 2022, it was all the way at 240,497. So for comparison, if we want to look over past years, active listings in 2015 were over 1.2 million. So while we're seeing an increase, we're still not anywhere near pre-pandemic levels when it comes to inventory. He goes on to note that despite the decline, 2024 has seen a positive story in terms of housing inventory, especially compared to the last few years. He says we can't assume mortgage rates will stay elevated in the 7 to 8% range forever, meaning that any rate drops could shift inventory again. So what's interesting here is that while inventory has been stabilizing, new listings have been experiencing a seasonal decline. As of last week in August, 2024 had the second lowest new listings recorded in history, with just 59,195 new listings. This is slightly higher than 23, but still, it's a significant drop from previous years. So what does that really mean for us as investors? Fewer new listings combined with dipping inventory levels could drive demand for the homes that are available. That seems obvious. That means for us at Groundfloor, fix and flip projects, new build projects, and rentals could become even more attractive as the competition among buyers increases. Another key factor that he points out is that trend in price cuts, meaning those homes experiencing price cuts while they're listed. Normally, about a third of all homes in the market see a price cut each year. But in 2024, this year, we've seen an increase in this activity due to rising mortgage rates or the elevated mortgage rate environment we've been in. The latest data shows that 39.3% of homes took price cuts. So normally in a normal year, about 33% of houses listed get price cuts. This year, we're at an elevated level of 39.3%. And that's up from 36% in 2023 and similar to 2022, which was also 39%. So what's the contradiction here? It highlights how different forces are working together in the market. So on one hand, fewer listings and low inventory are pushing demand higher, creating competition for the available homes. But on the other hand, affordability remains a challenge due to high mortgage rates or a high mortgage rate environment. So that forces seller to lower prices to attract buyers. That's where you see the price cuts and listings. This balancing act between demand and affordability is a key dynamic investors need to understand. You do need to pay attention. While demand is rising, price cuts are necessary to make homes more affordable for buyers, especially those facing financing challenges in a high interest rate environment. So in short, fewer homes on the market drive competition, but price cuts are needed to reflect what buyers can afford in the current economic conditions. So let's shift over to builder sentiment, which honestly it's been a bit of a mixed bag lately, this whole year really. According to the National Association of Home Builders, that's the largest trade group for builders, and the Wells Fargo index that they put out, builder sentiment hit 39 in August. What does that mean? Okay, well, that index it's measuring builder sentiment. It's going from 0 to 100. 50 is the midpoint. So above 50, you have bullish sentiment, and below 50, you have bearish sentiment. In August, this past August, in 2024, sentiment was at 39. So that's bearish. That's the lowest we've seen this year. That's mostly because of affordability challenges and buyers getting cold feet due to higher mortgage rates and rising home prices. And also, it's buyers waiting for the inevitable rate cuts that they've been hearing about that they expect. So there's an expectation in the market that mortgage rates are going to be falling, affordability increasing. So that's what they're noting with that sentiment. But here's an interesting stat. 33% of builders cut prices in August to move homes. That might help make homes more affordable, but it also presents a challenge for our ground floor borrowers listing newly completed projects, whether it be new build or fix and flips, in the same areas. So if you have a builder building homes on a larger scale in an area with our borrowers building one or two offs in that same area, a builder making larger price cuts across, say, a tract home neighborhood, that can complicate the ground floor borrower's optimal price discovery. So we're definitely keeping an eye on that, and it's something to watch. On the flip side, there's still optimism in the market because builders expect sales to pick up in the next 6 months, with a slight bump in the sentiment index up to 49. So while it's a bit of a roller coaster right now, there is hope on the horizon. So the builders somewhat pessimistic now, but over the next 6 months, this sentiment is expected to increase near or around that bullish threshold of 49 or 50. So very interesting to watch there. We'll see how sentiment changes over the next 4 to 5 months. And finally, let's talk about the most recent non-farm payroll report. That's the huge jobs report that everybody watches. Comes out the first Friday of each month. And the August report showed that 142 new thousand jobs were added. And that is a solid recovery from July's lower figure. That was an ugly number. And it's giving us really a clearer picture of this sort of slow, amoebic, maybe steady economic expansion. The slower job growth paired with the wages, though, is really sort of showing a soft landing. Its inflation is cooling without the economy tipping into a recession, God willing. And this is crucial, right, as the Fed watches this data intensely. And it's going to help them sort of get comfortable with the move they're expected to make in this September 17th and 18th meeting that's coming up. And it really is looking more and more probable that they're going to start cutting rates in that meeting. The FedWatch tool is nearly at 100% probability, and that's really measuring traders in the market taking positions. And those positions are sort of expecting the rate cut. So, and this is also building on what Jerome Powell hinted at in his Jackson Hole Symposium. He was really saying that the time is right for the committee to adjust monetary policy and start a rate cutting cycle. Hallelujah. Hallelujah. So for us as investors, this is awesome news. Lower rates mean cheaper borrowing costs, which can unlock new opportunities for financing projects and growing our real estate portfolios. And it's also great news for buyers as that affordability picture becomes clearer and more attainable. It's definitely what we're watching closely here. Okay, and that wraps up today's episode. We certainly have covered a lot from the ground floor stock offering to the latest housing inventory trends, builder sentiment, and the non-farm payroll report. There's no doubt that exciting opportunities are on the horizon for real estate investors. If you feel like you got your daily dose of vitamin housing, make sure to send us a like or give us a 5-star rating on Spotify. We'd really appreciate it. And as always, thanks for listening to Ground Floor Market Trends. Until next time, I'm Patrick Donahue. Happy investing.